Warning, listening to this show may result in increased levels of inspiration, motivation, and innovation. Side effects can include the immediate urge to take massive action to build a better business and life for yourself and others. You've been warned. Welcome to Influencers Radio with your host, Jack Mize.
And welcome back to another episode of Influencers Radio. Today, I think it's our guest is going to be talking about something that probably will be something very important for just about anybody listening, everyone listening, and probably just about anyone in your family, because it's something that can affect not just your family, your generation, but generations to come. And it's all about, your financial health and growing that financial legacy, but it's going to be a little bit different than what you may think, because our guest today is the host of the Self-Directed Investor Radio. And when you hear that term, self-directed investor, you may be thinking about, I make my own decisions on my stocks, my mutual funds, my bonds. And I'm going to tell you right now, you're going to want to hear this because it is actually completely outside of the box. It's not about stocks. It's not about bonds. It's not about mutual funds. It's actually about how you can skip Wall Street and build this financial portfolio and legacy for your family with real estate. Today's guest is Bryan Ellis. He is also the founder of the Bryan Ellis Investing Letter, which is a newsletter for real estate investors. He has over 700,000 subscribers that focuses on not the late night infomercial type stuff, but the real deal, real estate news, public policy that affects the individual investor. So I'm extremely excited to have him here today on Influencers Radio. Welcome, Bryan Ellis.
Thanks, Jack. How are you?
Well, fantastic. This is something that is really interesting to me, because I've had real estate in some of my investments for several years. And, I was kind of shocked when I first started learning about it and seeing what the real opportunities that you just don't hear about. Most people, when they think about real estate, they think about all the late night infomercials, but there's some incredible opportunities, not just in real estate values, but the ways that you can actually build a financial portfolio with real estate. And, you are the man, to me, with the final word on the subject. So I want to dive right into that whole concept of skipping Wall Street, because most people, when they think about it, that's what they're investing in: stocks, bonds, mutual funds, even in their retirement accounts. That's their only option. But you actually help people, like I said in the beginning, completely skip Wall Street, and use real estate. So let's talk about that. How does someone do that? Because it seems like that's the only thing you see is that option to invest in Wall Street.
Well, Jack, here's the reality. Most people default to investing in Wall Street assets, not because it's the best option available, but because it's what gets the most marketing dollars. And it's really the only thing that typical financial advisors are educated about. But here's the harsh reality of investing in Wall Street, Jack. When you invest in a stock, you are showing fundamental disrespect for your own capital. Here's what I mean. When you're investing in a stock, number one, there is nothing you can do to control what happens in that company other than issue your tiny proxy vote that's going to make no difference whatsoever. All right. That's the only thing you can do to influence it whatsoever. So you're giving up all control. But it's much more substantial than that, Jack, because when you invest in a stock that's publicly traded, what you're doing is you're saying, here, Mr. CEO, go ahead and pay all of your employers and contractors first. Go ahead and pay all of your taxes and insurance first. Go ahead and pay all your suppliers, pay all of your expenses, do everything you've got to do with money, do all of that first. And I'm happy just taking whatever is left over. If you decide to distribute any of that profit to me, I'm happy accepting the value of the stock going up if and only if you pay all those other people first. And if there's something left over, I'm happy taking the leftovers, Mr. CEO. So, Jack, that's what you're doing when you invest in a publicly traded company.
So it's like if someone came to me and said, hey, how would you like to buy a first-class ticket to be the last in line?
Exactly. That's a perfect description, because what you're doing is you're saying, I'm willing to take all of the risk. I'm willing to not protect my downside whatsoever. I'm willing to take the leftovers. This is retail investing, and nobody who's looking for a good deal on something goes the retail route. And that's the only option available on Wall Street.
And, a lot of people, with common logic and the way our brains work, when someone lays out as much money as they do when they buy stocks or mutual funds, if I was buying anything else, I would want more to show for it than a piece of paper. Right. If I buy a car, if I buy a boat, I buy anything. And we're talking thousands, tens of thousands, hundreds of thousands, millions of dollars.
Yes.
And you get a piece of paper that said, here, this represents what you've bought. Whereas I remember when I bought a first investment, I knew I could see it. I could drive by it. And even, when you invest out of state, you can get pictures of it. You actually see what's physically there. Right. Is that a tough concept for people to get their head around when they're investing in real estate besides, other than stock? What are those big obstacles to get people to think about, moving to that position?
Well, Jack, interestingly, it turns out that once people understand this notion of collateral, it no longer makes sense to be involved in the stock market at all. Here's how I explain it to people. If you buy a stock for $50 a share and you wake up tomorrow and that stock is dropped by 40%, number one, you got to ask yourself, is it plausible that could happen? I mean, what do you think, Jack? Do you think it's plausible that a stock could ever drop by that much overnight, or even over the course of a week or a month or a year?
Well,
I think it could happen.
Some stocks, not just plausible, but probable on some of them, I think, yeah.
It's happened time and time and time again, and it's going to happen time and time and time again, and anybody who denies that is denying reality. But here's the thing. The real question is not can that happen, but when it happens, what can you do about it? What do you have to back up the value of that piece of paper? And the answer? Nothing. That's why what we connect our investors with, we have this crazy little standard. It's what I call grandma cocktail party spouse. That's our standard. And what that means is an investment has to be simple enough to explain to grandma in under a minute. It has to be it has to be profitable enough to make you look like an investment guru at the cocktail party. And it has to be safe enough to get your spouse's seal of approval. There are no circumstances under which the stock market meets that standard. Sometimes it is profitable enough to make you look impressive, but it fails on the safety, and it completely fails on any reasonable judgment because there's just no way to back it up. So that's why we always recommend real estate-backed assets. Not because I'm crazy about real estate necessarily, but because if you invest in an asset that produces real cash flow, real value, but that asset has collateral backing, it has something real behind it, then what you are is you're in a situation where it becomes really hard to lose. And that's what I like, is a situation when you get into it that the odds are really heavily in your favor. Because here's the thing, Jack. Wall Street teaches the individual investor not to be wise about their money, but Wall Street teaches the individual investor that they should act like little venture capitalists. Wall Street teaches investors that they should view their money as kind of really basically a crapshoot. You're taught from Wall Street that what you should do is understand that there's going to be the good with the bad. There's going to be some wins. There's going to be some losses. And so long as you have an average that's good over time, that's great. What I teach my clients and members at Self-Directed Investor Society is this. You've got to respect your capital. Rule number one is don't lose. And the only thing that matters is that you make sure you are investing wisely so that you can make a lot of money in a way that's consistent, predictable, and reliable. And you never, ever adopt the mentality that it's okay to lose. That's the beginning of being a loser. And it's just not acceptable.
Right. And I think that's probably one of the first things that you're kind of, when you're dealing with stocks is you're inoculated to the fact that you're going to lose. So be prepared for that. And
exactly.
And it's kind of a very odd thing to accept. And also when you think about Wall Street, people, the names that you think of, the Bernie Madoffs, right? And when people lose, you hear people losing all this money, because they run off with their money, and it's probably tough to run off with real estate.
That's right. It really is. There's a natural line of defense because every separate transaction is documented. Every separate transaction can be owned individually. And if you don't want that level of involvement, you don't have to. There are ways to own things jointly and as a group as well. There's just tremendous flexibility. And again, it's not really necessarily about real estate. It's just that real estate happens to be an asset that really makes sense, that can't be taken away, that represents real value. And that's what I like to use as collateral for my investment. So it just makes sense all the way around.
Well, I'm glad you brought that up because I want to kind of dig a little bit deeper because most people, when they think about investing in real estate or invest in real estate, they think, here, I have $100 or $100,000. I'm going to go buy a little $100,000 house and rent it out. And that's going to be my investment. And that's where I'm going to make the money. So, you use the term real estate backed assets. Kind of go deeper into that, the difference in those options versus someone taking all their money out of their 401k or their savings and then buying one house and kind of, massaging that for the next 20 years, hoping that it's going to turn into something big.
That's an excellent question, Jack. Actually, there are three categories of investments that we really like at Self-Directed Investor Society. And one of them is rental property. Now, that is not the most capital efficient way to invest, but it is a really good way to invest because it does have the potential for substantial appreciation over time while you're still generating cash flow in the here and now. And all that's a good thing. But that's not the only thing we recommend. There are a couple of other categories as well. One of them is called tax liens. And done well, tax liens represent a way to make 15 to 20% a year in an almost zero risk environment. Now, I don't know about you, Jack, but if I can make 15 to 20% a year and take virtually zero risk, sign me up all day long. And so tax liens are really interesting. And so that's one of the things we do at Self-Directed Investor Society is provide actual data, actual information about where folks can get access to good tax liens that exist right now. So, most of our clients don't necessarily want to become masters of all the details of these types of investments. So we like to just connect them with providers and with lists and with data so that they can go and do it rather than having to master all the details. So one of the areas that we like is tax lien investing. But another area that we really like, Jack, that is really wildly profitable and incredibly flexible is investing in mortgage notes. Now, when I say that, people think about the financial meltdown and what happened a few years ago, and you should, because that is what has created so much opportunity. A mortgage note is exactly what you think it is. You probably gotten one when you bought your house. You went to the lender and you signed a note and said, I'm going to pay you X number of dollars a month for the next 15 or 30 years, and after that, you own your house. Well, that note is a beautiful opportunity for investing because what most people don't realize is that note that for example, has a face value debt of $100,000. Sometimes you can buy that note for less than $100,000. Sometimes you can buy that note for a lot less than $100,000. And the beautiful thing is you still get paid by the person who owes that debt as if you had purchased it for $100,000. So there's some real massive leverage involved. And the really beautiful thing is the entire time you've got the value of that piece of real estate that the loan was made against as collateral for that investment that you made. So not only do you get the cash flow, you get the security of knowing that the house behind it is going to be there in value for you no matter what the person who's paying the note actually does. And statistically, people pay their mortgages. Now, most people don't know this, Jack, but even back during the mortgage crisis, at no time was any less than 90% of America paying their note on time. It was always at least that much and generally more than that.
Yeah, I think that's where a lot of it had to be skewed, that people thought that, here it is, everybody's just, leaving their keys at their front doorstep and leaving and going somewhere else. And what you're describing is essentially someone stepping in and taking the place of what traditionally would be held by the bank.
Exactly.
And from what I've seen, banks are the ones that end up making out the absolute best in the good or bad times of this, because even when things went bad, the banks still were the ones that had the assets.
That's absolutely right.
When everybody walked away from, their investments, some people got left with nothing. I guess when you have that real estate backing your investment, there's no way for you to be left with nothing.
That's right.
There's a I don't know what you would call it, a buffer there that regardless you have something, regardless what the market.
That's right. That buffer that you're talking about, Jack. The word we use for it is collateral, and collateral is the difference between being a careful investor or even a banker versus being a gunslinger or a venture capitalist. See, we always tell our members at SDI Society that you've got to have collateral. There has to be some real value involved. It's not just about what's sexy and what all your friends are talking about. It's about what's going to make you the most money and do it in a safe way. And the way you get safety is by having real value in the form of collateral backing up every dollar and more. See, Jack, what I like to do whenever I'm investing for myself is I like to make sure that there's at least a 50% buffer between the amount of money that I put up as an investment and the value of the collateral behind my investment. So if I'm going to invest $100,000, the collateral that I get has to be worth at least $150,000. That means there's a massive buffer before there's even any risk that I'm going to lose anything. Does that make sense?
Oh, yeah, absolutely. I guess you're buying at a discount. That's what you're doing. I guess it's almost like you're buying wholesale real estate or wholesale real estate notes.
Yes, exactly.
And which is what anybody needs to do. If anybody that's ever run a business, been an entrepreneur, there's got to be a profit margin in there. And,
exactly.
Regardless. And that's kind of what you're building in automatically, I guess, when you're doing that. And one of the things I want to point out is, some of these things that you've unfolded, is already kind of busted through some of the myths that a lot of people think that if I deal in real estate, that means I'm going to be having to, get up in the middle of the night to go unclog toilets and things like this.
No.
When you're talking about dealing with these real estate backed assets, like the notes and, tax liens, there's none of that involved. It doesn't sound like.
No, that's not involved. You see, Jack, my clients at Self-Directed Investor Society are doctors, they're lawyers, they're entrepreneurs, they're professionals. These are folks who are not interested in being real estate investors on an active basis. They don't have that expertise. You see, one of the things that I learned about this type of person over the last several years is that they trust a strong relationship over their own ability to learn a new skill, because they don't want to learn a new skill. They're already good at something. They're already a doctor, a lawyer, an entrepreneur. They've already got a business that's going well. They're already making money somehow. They don't want to be involved in something that's going to cause them to have to unclog toilets. And frankly, I don't either. That's just not a good use of time. So we don't really drive people in that direction. Even when we do connect people with rental property, which is something that we do believe in, you've always got to have a third-party manager that handles all that sort of thing. But, we also connect folks with notes instead of rental property, because that's a great way to generate cash flow just like rentals, only you actually don't have any legal requirement, any legal responsibility to unclog the toilet or to fix the air conditioner. That's completely on the back of the owner of the property, which is not you. So you don't have to do any of that. So you're right. None of that's involved, and it shouldn't be for this type of client.
Right. If I buy a house, I'm not going to get to call my bank and say, hey, I got a little roof problem.
Right.
Come on down. That's
yeah, they're going to tell you to fix it.
Yeah. So that really is, it opens up, I think, some opportunities for people that think that, real estate, boy, there's a lot of headaches, but not necessarily when it comes to, that. Now, the other thing is, if I'm listening to this and I'm saying, this makes sense. I didn't realize that these opportunities were, available, but, I'm working, I've got family, I'm, spending, but all my extra money goes to retirement. All my extra money goes to my 401k or to my IRA. I don't have any money to go and buy tax liens or anything right now. What do you say to the people that are in that situation?
That's a wonderful situation to be in, actually, because there are things called self-directed IRAs and self-directed 401ks. that allow you to invest in virtually any kind of asset that you want, including the ones that I've just described. So for those of you who are squirreling away most of your savings into retirement accounts, well, good for you, because you can still use that money to do these types of investments. And that doesn't change anything other than it means you just don't have to pay taxes on those on the returns you get.
Now, I know, if I call down to the brokerage that I have mutual funds in, I don't think there's an option for me to say, hey, take it out of that mutual fund and
right.
buy a couple of houses.
Right.
How does that work to be able to use that?
That's a great question, Jack. The answer is that depending on which type of account you want, there's really two different types of accounts. One's called a self-directed IRA and one's called a self-directed 401k. And you use an IRA if you are not a business owner. You use a 401k if you are a business owner. But what you do is you go to a self-directed retirement account custodian, and we have a list of those over at sdiradio.com that folks can check out. You go and you pick a custodian and set up an account with them, and it's not going to be somebody like Schwab or Fidelity. They say that they have a self-directed account, but what they really mean is that you can self-direct your account so long as you choose a stock or a bond or a mutual fund. What you need is the ability to self-direct your account into non-Wall Street assets. And so the list we have over at sdiradio.com will give you a long list of the folks who can set up that kind of account for you. And then you're off to the races. All you have to do is reach out to the custodian that you work with and say, I want to invest in asset XYZ, and they will make that happen for you.
Well, I can say that's why I feel that you are clearly an influencer by, bringing this to the light and kind of unfolding these opportunities for people. Because the fact is, when you turn on the financial channels on cable television, you're pretty much given that same, here's what the stocks are doing, here's what the mutual funds are doing. You rarely hear anything about these opportunities. And, what do you think is, why? Because to me, it's just, some of the stocks and mutual funds, it's like, might as well go to Vegas and throw it on red or black, but they don't, it's not something that they show as a very viable and quite possibly and probably a far more secure alternative to doing that.
Well, there is no motivation for the financial industry to expose this type of asset because stocks are really, really easy to be brokered and really, really easy for firms to be able to collect commissions from. Now, you can collect commissions from real estate as well. Real estate brokerages do it all the time, but it is a more complicated transaction. And so Wall Street naturally gravitates towards the things that makes it easiest for them to make money. So that's why you're never really going to see these assets being compared side by side. And the other reason, frankly, Jack, is this. I mean, we have a training we're doing this week that we're going to be talking about a strategy that has been producing consistently 15% annually plus for a long time. Now, if Wall Street is able to produce 15% consistently for a long time, they'd be crowing from the rooftops, but they can't do that. I mean, 15% is a banner year that everybody hopes for. So it just makes no sense for them to trumpet the competition that clearly is superior. That's the bottom line. Yeah.
Well, one thing that I think is important and something that you are very, I would consider you a true advocate around is if you think back to the late 90s, anybody that opened up an E-Trade account made money in the stock market, whether it was penny stocks, and they, unfortunately, got some false confidence in thinking they were a great investor.
Right.
Where really they were just kind of throwing it out into an insane, market. And so one of the things that you're very, clear on is, no, this isn't something you just throw money at anything and it's going to work. That people have to educate themselves around, and regardless of what you're going to try to make money or investing or to build a financial, you need to be educated, and that's something I think is sadly missing from the stock and mutual fund, where they, the status quo is to go find a broker or someone that says that they can, buy and sell stocks for you and just kind of blindly give them this money and kind of cross your fingers. But you are very, very pro, educating, investors around this before they make these decisions on what to actually put their money down. And how do you do that?
Yeah, well, that's a great question, Jack. And I'd say it's even worse than that as far as Wall Street's concerned, because there isn't a disincentive for there to be any real education of investors on Wall Street, because the more you know about how Wall Street works and what you're really investing in, the more you understand that it simply doesn't make sense as a basis for your investment strategy. We do it differently. For example, the training that we're doing, that we do a training every week for our subscribers and for our listeners. And the one that we're doing this week deals with the opportunity I mentioned just a moment ago that is showing a really strong long-term return. I mean, really, really strong. It does involve real estate. It involves buying houses at a low value and having a team repair them and resell them and collect a pretty substantial spread. We are not going to tell anybody that they need to go do that. What we're going to do on this webinar instead is say, here are a bunch of examples where this strategy has worked. Here are the people who have done it. Here are the circumstances that they faced when they were dealing with it. And your next step, Mr. Investor, if you're interested in this, is not to write a check. Your next step is to come out and meet every single person that we just talked about. Your next step is to come out and see all the properties that we just described to you. And by the way, there are more than 10,000 examples in this particular case. Your next step, Mr. Investor, is to come out and see all the other people who are getting involved in this as well and make a decision for yourself. See, what we'd like to do, Jack, is actually teach them enough that if they wanted to, they could go do the entire process themselves. Not because they're going to do that. We know they're not going to go and do this entire thing themselves. What we do know is that when they see that we know what we're doing, that we not only have experience, but we have a clearly defined process, a right way to do things, that we have economies of scale that really make sense. When they see all this, it really makes sense. It becomes, over the course of a couple of days of really intensive education, you get to the point where you can explain it to grandma in under 1 minute. And you understand why you're going to be making a lot of money and going to be doing it very, very safely. That's the approach that we take.
Yeah, and I think that's something that is again, why I consider you an influencer, because of the way that you do that and the effort you put into educating folks around this. And I guess that's one of the reasons that you started Self-Directed Investor Radio.
Yes.
I want to tell us a little bit more about the Self-Directed Investor Radio and what someone can learn there and what they can expect when they go there.
Well, yeah, I'd love to. Self-Directed Investor Radio is really my passion right now. It's a podcast that we started about 3 weeks ago, and I am thrilled to say that the results have been astounding. We've been getting a lot of listeners, a lot of traffic through there, and I'd love it if any of you guys would stop by iTunes at the page for Self-Directed Investor Radio and subscribe and listen. We have a little bit of a different format, Jack. It's a daily show, but it's only 7 minutes long. I don't want to put any fluff in. I don't want to waste anybody's time. It's a 7-minute show that happens every day, and it's pretty serious. It's deep content that you're not going to hear in other places. For example, over the weekend, we did a show that really shined the light on IRAs in a way that almost nobody does. For example, there is a common belief that if you have an IRA, that you can't lose that IRA to a lawsuit or to bankruptcy. And the reality is very, very different than that, but nobody knows, except for those of you who listened to the Self-Directed Investor Radio podcast over the weekend. Similarly, a lot of people think that the only way to have an IRA and to be able to get access to the money is to be old enough to retire or to reach 59 and a half. Well, there is a type of IRA that you can get money out of anytime you want from day one. And almost nobody knows that, but we covered that in just a couple of weeks ago. Furthermore, we do a lot of market analysis. We look at specific real estate markets and say why we like them or why we don't like them. We deal with topics that are kind of thorny, such as prohibited transactions. There are things you can do wrong with your IRA. And that kind of leads into the discussion about how you can lose your IRAs to bankruptcy or lawsuits, and also how you can protect them from those sorts of things. So Self-Directed Investor Radio is a different kind of show for an affluent, self-directed investor who really wants to be able to move to the next level, but do it safely and do it without being dependent on Wall Street or on the government.
Yeah, and that's one thing that I want to make sure and put a spotlight on, because what you're showing people, they aren't like loopholes or ninja tricks or anything that raises flags. These are things that the IRS and the government fully have laid out as options that just very few people take advantage of, or that even a lot of financial professionals even recognize. So that's one thing that a lot of people get kind of worried about, and I know I do when people say, "Oh, there's this loophole they left open that allows you to do this." And to me, that's like, well, if it's a loophole, then it may be something that's going to raise flags, or if it comes down to substance over form kind of thing, that it may not be the right thing. But what you're showing people are like, no, here it is right here. This is what they could call the IRS and verify that these are real options and opportunities that are there. But if people don't educate themselves around them or take advantage of them, then they're not going to promote it.
And I'm glad you said that, because there is one strategy that I mentioned just a moment ago. There's a type of Roth IRA that you can actually make withdrawals from long before you reach 59 and a half. I've known about this for years and loved the strategy for years, but I didn't talk about it publicly until about 2 weeks ago. And the reason I waited until about 2 weeks ago is because it wasn't until probably 3 or 4 weeks ago when Obama released his budget for 2016, and this particular strategy was referenced in that budget, which at that point tells me that there's clear awareness of this strategy. There's a tacit acknowledgement that it is a legitimate strategy to use. And so at that point, I took it public because it makes sense at that point. But before then, no, I love doing things that will save taxes, but I will never recommend anything to anyone that will even cross them into a gray area. It just doesn't make sense, because there are too many ways to actually do these things correctly so that you can sleep well at night.
Yeah, that's powerful stuff. Bryan Ellis, how can people find out more about the ways to listen to Self-Directed Investor Radio and find out about your newsletter as well?
Yeah, Jack, the best way to get to the podcast is to go on iTunes and search for Self-Directed Investor Radio, or you can go to our website, sdiradio.com/iTunes. Again, that's sdiradio.com/iTunes.
All right. Fantastic. Bryan, I want to thank you for coming on to Influencers Radio and sharing this information. And like I said at the top of the show, it's the things that affect just about any family out there, and not just them, but for generations to come. This can make a huge, huge difference and impact on their financial legacy. So thank you very much for coming on and sharing that.
Thanks for having me, Jack. I've enjoyed it.
All right. Folks, there you have it. Check it out, Self-Directed Investor Radio. We'll have the links there right on the show post. Until next time, here on Influencers Radio, remember, you are the only real game changer.
You've been listening to Influencers Radio. To get all past shows and updates on future shows, visit influencersradio.com today, or follow us on Facebook at facebook.com/influencersradio.